NASDAQ selling off another 2%. Now people are asking if the AI bubble is popping. Here with his top picks and to explain what's going on, Michael Landsberg is CIO at Landsberg Bennett Private Wealth Management. Michael, I don't know if you relate this back to the Fed on some level or if this is just, things got a little bit too rich and now we're experiencing some kind of reset.
I think it's a little bit of a reset. Obviously, a lot of AI stocks had a great run, 6 months a year. And this is a typical process where we do kind of rotate out of some sectors. It doesn't mean we're not positive longer term on AI, but when you have big runs like that, that's why you rebalance portfolios to keep the risk in check. And I think ultimately, we're going to get some Fed action, but I think ultimately earnings drive stocks at the end of the day. And I think that's kind of what you're going to see is stocks continue to drive earnings and prices will go higher.
Is that true? I don't want to mean is that true, because obviously you look at a Merck, look at a JetBlue. Yes, earnings drive stocks, no question. But so for those who are following this and saying, this is it, the AI bubble's popping, that's it, it's over. I mean, do you think that's what's really going on here?
Absolutely not. I think what's happened is you're having some deceleration from some of the rapid growth that we had. And there's some normalization in terms of what the prices should be. I mean, if you're looking at kind of how AI has kind of basically taken over our vocabulary, yeah, it's probably gotten a little exuberant. But at the end of the day, a lot of these companies are going to drive earnings going forward. Are they going to grow at 250% year over year? Of course not. And so that's kind of what we're coming off of. But the internet itself and a lot of the things that we saw, the cloud weren't straight up. They had these fits and starts. And I think that's what you've got now. You're getting a resetting of some of those names. And some of the names are going to deliver and some of them aren't. And I think it's a stock picker's market when it comes to AI.
I know.
Following a significant decline in the chipmaker's shares the day before due to a sell-off in the broader market, Morgan Stanley analysts reaffirmed their top pick rating for Nvidia stock on Wednesday. Tuesday saw a 7% decline in Nvidia's closing price to $103.73, the lowest since May. Subsequently, the A-shares semiconductor ETF saw a 3.6% daily loss, along with other semiconductor equities. Although Morgan Stanley kept its Nvidia price target and projections unchanged, it did observe that the sell-off offers a solid entry point given the strong long and short-term data points and exaggerated concerns about competition. Customer capital investment budgets, competitive dynamics, export controls, and supply chain problems are some of the main causes driving the sell-off. The bank's experts are aware of these difficulties, but they think they will pass. For example, because to space and power limitations, customer spending on AI infrastructure has not been linear, but there is still a high demand for Nvidia's GPUs. Analysts pointed out that the H100 GPUs from Nvidia and the next Blackwell series makes those spending concerns seem premature. Nvidia's stock has been under pressure because to competition from companies such as AMD, Apple, and Amazon. But Nvidia's dominant position in the AI space and its capacity to win over clients from competitors offering custom chips demonstrate its persistent competitive advantage. A single Nvidia card will not be sufficient to service this market, which is quite huge. However, analysts said that they are hearing about numerous cases of clients who spent money on alternatives or bespoke silicon returning to Nvidia for profit. Analysts noted that although there are geopolitical risks associated with export control, Nvidia's small trailing revenue from China mitigates any implications. This is especially true for export control issues pertaining to China. Moreover, Nvidia's A20 product's flexibility to satisfy export specifications guarantees its market presence even in the face of regulatory obstacles. For the most part, the Wall Street behemoth continues to have an optimistic outlook for Nvidia stock, mostly due to high consumer enthusiasm for the Blackwell GPUs and good demand indications. In fact, visibility will get better as demand shifts from Hopper to Blackwell and Silicon becomes once again the constraint. With all these developments under consideration and analyst predictions, we'll talk about target projections and advice in today's video, so make sure not to miss out. However, before you do, if you'd like to stay up to date on NVIDIA's most recent updates and the most recent news from the stock market, you can subscribe to our channel. We publish daily updates about the biggest shifts in market catalysts, so click the bell icon button to ensure you don't miss the most recent updates. All right, back to today's video.
bought all those companies and crunched them, except for I wrote it. Consider the case of Nvidia, which is doing amazing things with generative artificial intelligence, generative AI, and accelerated computing. Those are the two biggest trends of our day. Those are basically their own cycles with their own rules, and they have nothing to do with the Fed. That's something we love them for. Not anymore. That's how Nvidia stock has become a wasteland. I mean, you know, it's this interstitial gunfire. I mean, every day. I mean, thank heavens that the market stops. Thank heavens they ring a bell. Because then it can stop going down. Okay, sure, it's still up 110% for the year, but it's now down more than 35 points from its high, 140 to 140. I don't see it stopping here. That's not because Nvidia's business has deteriorated. Its products are selling amazingly well. Its competitor, AMD, on tomorrow and Squawk of the Street saying good things. It's because Nvidia doesn't benefit from rate cuts. So its stock gets kicked to the curb in this environment. The money you get back from selling the company's shares that are being redeployed are to the rate cut beneficiaries. No insult to Nvidia. It's about the stock, not the company. So why not get rid of the stock? Because Nvidia stock is getting cheaper as it goes down. Right now, the street expects them to earn $3.59 per share next year. But if this is anything like the Nvidia we've seen in the last decade, those estimates are probably way too low. Maybe so low that the company could eventually earn $4.59 per share next year. In that case, you've got a stock that's conceivably selling at less than 23 times next year's earnings. I am not selling the greatest growth stock of our generation at 23 times earnings. I'd rather risk taking some pain. And maybe then, keep in mind, Nvidia is the premier growth stock of our time. I'm going to say it again. It's not going down just because skeptics feel there's no good return on investment AI. It's going down because Wall Street's become a lot less willing to pay up for the earnings of growth stocks. It's called multiple contraction. Right now, investors would rather chase cheaper stocks of companies that will get a massive earnings boost from lower interest rates. Think Stanley, Black & Decker. Wall Street at certain junctures falls out of love with great growth stocks, abandoning them for cyclical stocks that will do much better in accelerating economy. The year-over-year comparisons are just much better with these rate cut beneficiaries than they will be with the Mag 7. The market runs on these companies. But at some point, a stock like Nvidia gets so cheap, so darn cheap, on an earnings basis, can you believe it, that the selling will stop? We just haven't reached that level yet. I don't mean to be picking on Nvidia. Microsoft, Meta, Amazon, Apple have all been experiencing multiple contraction. Meanwhile, stocks like Stanley, Black & Decker, or the banks are experiencing multiple expansion. Glorious. Now, we hear that many smaller cap stocks are winning here. It's the big techs donate share to them. Donation is a very tricky word, though. What's really happening is that big institutions aren't doing anything different than they usually do. They always sell the stocks that don't need the Fed to make the estimates and buy the stocks that will put up huge year-over-year earnings growth with the help of rate cuts. Of course, there are stocks that are basically bits and bobs. Procter & Gamble and Merck missed the numbers today. I can tell you if it weren't for China, those stocks would have actually gone higher. I'll go over China losers later in the show. Eli Lilly keeps going down because it's been up a lot. It suddenly has GLP-1 competition. But it's also suffering from the same multiple contraction as the Magnificent Seven. We don't know when that will stop either. A quality company, real bad stock. It's so easy to just dump all the great growth stocks that have done so well when you have cycles based on cell phone refresh or PC refresh or AI or accelerated computing. You sell them and you will feel so instantly relieved. You'll be like, oh, a steamer trunk removed from my back. Never forget, though, that you're selling winners, actual bona fide winners for stocks that were losers just 2 weeks ago. Selling winners for losers is indeed a longer term a mug's game, unless you think this rotation has immense multi-year staying power or you're a hedge fund with the ability to flit in and out.
Analysts went on to say that while H100 lead times are short, H200 lead times are already lengthy, and Blackwell lead times ought to be considerably longer. They feel the market is seeing some of the hyperscale comments, where there is a clear desire on the part of customers to continue devoting resources to developing multimodal generative AI. Very dimly, given the valuation, which looks a lot more reasonable than it did a few weeks ago. Is the state of AI currently in its fourth inning? Ali Mogherabi, senior equities analyst at West End Capital Management, talked about Nvidia's competitive edge and the potential of million-chip data centers in the future. According to Mogherabi, Nvidia has successfully transitioned into a full-stack platform, offering more than just GPUs. According to Mogherabi, Nvidia has been able to create a safe haven thanks to this tactic. The analyst notes that while powering data centers is a concern, Nvidia software is contributing to chips operating at higher efficiency. Artificial intelligence, AI, has arguably been the hottest trend on Wall Street in the past year and a half. In short, AI makes it possible for computers and software to manage jobs that are typically performed by humans. AI has the ability to change the game in terms of growth because software and systems can learn on their own without the need for human interaction. This would enable software and systems to develop and acquire new skill sets, as well as help AI-driven systems become increasingly adept at the tasks they are given over time. Because of artificial intelligence's immense potential, POC researchers project that by 2030, the global gross domestic product would have increased by $15.7 trillion. The semiconductor giant Nvidia has benefited more directly than any other publicly traded company from the AI revolution. The corporation is on track to generate $120 billion in revenue and more than $64 billion in net income for the current fiscal year, following the achievement of $27 billion in net sales and almost $4.4 billion in net income in the previous fiscal year. So what does this really mean for Nvidia's stock? Let's find out, but first, if you made it this far into the video, thank you. These videos take a lot of effort and time to make, so if you enjoyed them, please hit the like button, subscribe to the channel. This goes a long way in helping us grow. That said, back to the video. AI remains worth watching segment for global investors in 2024. But how do you keep up with the AI sector and others that you may be interested in? I recommend trying Moomoo, a sponsor of today's video. Some features to discover stocks with investment potential has blown me away. You can use the industry chain to find companies throughout the entire AI sector, or use the stock screener to filter stocks according to your investment strategy. Having the option to set parameters like industry, market indicators, financial indicators, technical indicators, and more. Ultimately, discover potentially undervalued stocks and those that appear to show buy signals to help inform your strategies in an effort to capitalize on AI-related opportunities. At the same time, Moomoo is one of the cheapest trading platforms I've found. It offers zero commission on stocks, options, and ETFs. After comparisons, I've discovered the fees are among the lowest. Right now, new users who open an account using my link and make a qualified deposit can get up to 15 free stocks, enjoy a limited time 8.1% APY on idle cash for 3 months, and earn up to $300 cash reward for transferring in their portfolio. These rewards can be earned together, so don't miss out. And thanks again to Moomoo for sponsoring this portion of the video.
Oh, you mentioned us potentially being in the fourth inning here of some of the AI kind of landscape and this next iteration, we should say, of AI, because it is a kind of decades-long journey that we've had just to get here. But all these things considered, we've heard a lot from companies like Nvidia about a future where there is a 1 million chip data center. For Nvidia, what more do you need to hear from them when they report this earnings season about how close we could be to eventually seeing that? When are we going to see, from your estimation, these 1 million chip data centers?
That's a tough question to answer. That's tough to tell. So unfortunately, at times improvements and/or innovation in technology suddenly skyrocket, and at times, we basically feel satisfied with what we have, and we continue to utilize that. So it really remains to be seen. It could be 5 years, it could be 10 years. I can't really answer that question. But in terms of NVIDIA, though, I think they've done a pretty good job by basically having that full stack of products, right? Having that full stack of offering around their GPUs. Because some of the main issues that we're facing overall when it comes to the AI cycle, for example, is power, is electricity. I mean, those data centers need to be run 24/7, especially when you're talking about the training side of it. So the question is, can those chips operate a little bit more efficiently? How can you allocate, again, more efficiently power to, at certain times to certain parts of the servers and the data centers to certain tasks. And what's good about NVIDIA is it does provide the software that can help do that. So that's just one example of that full stack that it provides. So, given their current leadership, of course, the first mover, and they've got a dominant market share, it seems that all of that full stack may create a switching cost for those guys. And that's a pretty good moat, pretty good competitive advantage to have. So So I think they're still actually very well positioned in this entire AI cycle that we're experiencing right now.
Investors right now who've been tracking the ticker symbol NVDA, they're also seeing in the second half of 2024, Nvidia shares down right now by a little bit more than 10%. All that considered, what would you say to those who are looking to try and figure out what a viable entry point is to Nvidia, even at this juncture?
Yeah, it's tough. It's declined a little bit. It's given back. I mean, there is some sense that there is some rotation into the SMIDs, or I should say, small mid caps. As we've seen, Russell 2000 perform pretty well. But in terms of our valuation, we value it currently at around, between 140, 150. So I would say probably some additional downside may be needed for new investors to come in. But for investors that are in the name right now, I think it's better to remain with the leader in the market, in the AI market, and that's benefiting from all fronts when it comes to AI development, and AI growth. So that's my view on Nvidia.
Ali Morkarabi, who is the Senior Equity Analyst over at West End Capital Management. Hey, great to have you here with us this morning, and thanks so much for the timely insights and analysis. Appreciate it.
NVIDIA's H100 Graphics Processing Unit, GPU, quickly emerged as the industry standard for companies looking to run generative AI applications and train massive language models. The company's QDA software, which keeps developers within its ecosystem, along with the overwhelming demand for its hardware, have contributed to the GPU's increased selling price. In summary, NVIDIA has an abundance of operating cash flow, while a significant portion of its funds is being invested in research and development to maintain its AI computing advantage. NVIDIA has also been investing a portion of its funds in potential AI startups. Based on its Form 13F from the first quarter and a newly filed Form 4 with the Securities and Exchange Commission, SEC, NVIDIA owns investments in 5 publicly traded firms. However, 4 of these assets account for 99.9% of its $380 million AI-inspired investment portfolio. NVIDIA's $380 million investment portfolio is primarily owned by ARM Holdings, a semiconductor business focused on intellectual property (IP). As of the closing bell on July 26, NVIDIA had 1,960,784 shares of ARM, or more than $292 million in market value, at the end of the March-ended quarter. Since ARM's September 2017 initial public offering, IPO, at $51, its shares have almost tripled. While the majority of semiconductor companies are fighting to dominate the hardware market, ARM Holdings has successfully carved out a special place for itself in which it can simply sit back and earn licensing and royalties. ARM is a developer and designer of systems intellectual property, GPUs, and CPUs. Since NVIDIA and other companies employ ARM's designs in their chips, ARM is able to charge licensing fees and slash or royalties. It's an operating strategy with strong margins, but without the overhead that can often bankrupt traditional chip businesses. ARM indicated in May that the development of artificial intelligence, AI, and the demand for more energy-efficient designs would be major factors in driving its royalty revenue stream going ahead when it released its fiscal fourth quarter results for the period ending on March 31, 2024. With all of these considerations, NVIDIA is unquestionably a great buy, especially if you're looking to invest for the long term because the company hasn't reached its full potential yet. What do you think about NVIDIA stock? Is it a good buy at the current price? Please share your opinions with us in the comments section, and don't forget to let us know what you think NVIDIA is worth. If you're interested in learning what other companies, like NVIDIA, have been up to lately, click on the next video on your screen. We'll see you there.